Well, welcome to our weekly High Rock video for our clients and guests who might want to join us and hear a little bit about what we're talking to here. What we try to do is talk a little bit about the global economy and talk about financial markets and other aspects of wealth management that we think are worthwhile. And how this affects what we're doing with our models and our client portfolios. My name is Scott Tomlinson, and with me is the founder of High Rock, Paul Tepsich. So let's get to our models. I know there's not been a whole lot going on this week, but let's talk to our clients and tell them what we're doing and what we're thinking.
Yeah, it was a shortened week last week because of the U.S. holiday, and for our listeners, the Canadian markets kind of get quiet too. So Thursday, Friday, we're sort of quiet. We did, in our models, make some changes. We had some new accounts come in, and we got them invested up in some specific securities. And for the other existing clients, we did add a little bit into one of our energy oil stocks, mostly an oil stock. We've traded this stock around a little bit, and it is in our tactical model, and we're being kind of tactical with it. So we did add to that, and that was really the only position change in our portfolios overall.
And again, as Paul said, a quiet week, generally speaking, for the economy. The one thing we are focusing on a little bit right now is the holiday shopping season and then how that's going to impact consumer spending and what the consumer is going to do. But it's still early going in that, and we'll be keeping an eye on what and if that has any significant impact on the economy. Of course, we're also monitoring what's going on as far as the U.S. Tax reform situation is concerned.
I think that vote is
Thursday,
yeah,
and we'll be watching that. At this juncture, it's pretty much built in, but we'll see if there's any residual effect.
Who knows?
One of the important aspects of what we do is trying to make sure that when we manage our clients' money and we invest it as we invest our own, and that's an important concept that we have. Paul and I invest our assets, our money, in the exact same assets that our clients are invested in. So we have a vested interest in making sure that our money is working, and we obviously want to make sure our clients' money is working. So when we invest in our models and our portfolios, we want to make sure that we're taking appropriate risk to get an appropriate return. So one of the things we often talk about is the risk that we're taking in terms of return. So the return that we receive per unit of risk taking. And in this particular chart, we're showing 5 years so that we can actually compare a client that has been with me and High Rock for the last 5 years and how their portfolio has performed, as well as what kind of risk that portfolio has had to endure during this period of time. Paul, do you care to comment here a little bit?
Sure. So we use monthly total returns to calculate all these different indices and this actual High Rock client. And we kind of regress back over the 5 years on a monthly return basis. And we come up with this. And then once we get the compound annual total return, we calculate a standard deviation, which is commonly seen as a measure of risk, which you can see at the bottom of the chart. And that's this scatter plot diagram shows risk-adjusted returns. And then in the top part, in the table, you'll see return per unit of risk, as Scott just mentioned. And that is a very important metric that we look at as well. And that's kind of commonly known, and this isn't the exact calculation, but commonly known as a Sharpe ratio. But it's effectively, you can't just talk about return without looking at what kind of risk you are taking. So we monitor both returns and risk, and we do so by looking at the risk per unit, return per unit of risk.
And just to explain just a little bit further, standard deviation as a concept is just what happens in a particularly volatile period when markets and assets move in price relative to the volatility, correct?
Yeah, I mean, standard deviation is how much they are moving from the mean return.
Right.
So you want to be as have the lowest amount of standard deviation from the mean as possible, while achieving the highest amount of return. Which means in the scatter plot diagram, you want to be in the top left quadrant, not the bottom right quadrant. If you are in the top right quadrant, you're getting more return, but you're also taking more risk. And you can see, in fact, the S&P 500 and the TSX and the ACWI are sort of in that top right quadrant, but they are taking more risk.
So we compare what our clients are achieving, both in return and risk, and you can see on this graph at the top the actual High Rock private client, or HRPC. You can see the 5-year return. Now that return is after fees.
Yep.
And then the risk associated with the portfolio that they're invested in. And underneath that, of course, is the return per unit of risk. If we go over to where we have the far right, where we say 60-40, now that is a combination of 30% of the All-Country World Index, which is a global equity index, 30% of the S&P TSX, which we feel is representative of a portfolio that our clients have, and their risk that they have relative to what's in the S&P TSX.
Yep.
And then, of course, the XBB is the ETF for the Canadian Bond Index, so we can make that comparison. So the idea here is that this is a blended benchmark.
Yep.
For which to compare to your own performance. So we look here at what's gone on in the particular indices over the course of the last 5 years, and we can see that we are using these particular benchmarks to give us an idea of what's been achieved. So for example, the All-Country World Index over the last 5 years, the annual return has been a little under 17%, but we're only using 30% of that in our portfolio or in our benchmark. So we want to compare that. It comes out to about a 5% annual return to contribute to our combined benchmark.
And that's in Canadian dollars, though, right?
That's in the Canadian. That's a Canadian dollar equivalent.
Right.
We'll look at the S&P TSX in the same manner, where we have the 5-year annualized return. Average annual return is about a little under 8.5, which comes out to about 2.5 when it's 30% of a portfolio. And then, of course, bonds are approximately 40% of the portfolio, and they've returned about a 1% contribution to that portfolio. So when we take all of those together and we look at a 5-year combination, or even a 1-year combination for that matter, we can then have a comparative with which to look and see how we're performing on behalf of our clients relative to that performance. And here's the actual High Rock client that we've been using. And as you can see, now this again is after fees. Those benchmark numbers don't include any fees, so you have to take fees into consideration if you want to compare apples to apples. But we can see here that a 5-year High Rock client has performed pretty much in line with what the benchmark is showing, and if there's fees attached, then of course this is an after fees number that we're looking at.
So that
here.
would look at 816 would work out to roughly 930.
Something in that vicinity, right?
Adding back about 1.15 in our fees.
Correct, absolutely. So that's it for today.
We should
always
caution our listeners that performance is no guarantee of future performance, etc.
Absolutely, and the regulators would want us to make sure that we're doing that. So yes, absolutely, past performance is no guarantee of future performance.
There you go.
But at High Rock, we work very, very hard to make sure that we are getting the best risk-adjusted returns for our clients. And of course, this is always to be taken in context with each of our clients' individual situations. We prepare wealth forecasts for our clients in order to know how their assets should be allocated accordingly to meet their longer-term goals and objectives. So,
and we could probably add here too that the wealth forecast is the basis for how we create a portfolio and take risk for our clients. So we really don't want to take any more risks than we need to for our clients to meet their goals.
Absolutely.
We're not trying to shoot the lights out here.
Well, I certainly don't want to take more risk than I need to. So if that is the case for each of us, I think that certainly must be the case for our client.
Agreed.
So. Anyway, thanks again for tuning in today. We will be back next week with another edition. Until then, we wish you all the best.
Have a good week.